In this video, you'll be learning about this topic.
Alright guys, so before we started recording, it was just Preston and me talking for a few minutes before we dialed in Hari and Toby, and Preston's comment was, you have a very bold pick. And when Preston is saying bold, it sometimes means bold, most often it means stupid. You know, he's just a very polite person, so just keep that in mind as we go into this pick. My pick is Foot Locker. The stock ticker is FL. And I usually pitch one or two things here. You know, either it's a stock pick with promising growth prospects that are just not having like high current earnings, at least compared to the price. And, you know, I previously pitched Google, Spotify, and Alibaba here on the mastermind group. And the three of them have worked out pretty well. And it's positions that I still hold. And then I also pitched stocks that are cash flowing really well, but the prospects are just, you know, very modest. And, you know, examples would include AT&T and Allstate. Companies with a very narrow moat, just like Foot Locker. We're riding 2020 and trading at a low price to free cash flow is just not in fashion anymore. The promise of earnings in the distant future is really all what this game is about, or so it seems. So I really can't help myself, but I am still going to pick one of those ugly picks, and you can already criticize me for all the same things that I criticized Toby for before, with like value underperforming and all the horrible things about value. But, you know, I am a slow learner. I have been keeping up with a few tech stocks, but at the end of the day, I like these ugly but cash flowing stocks like Foot Locker. So most of you out there probably already know the company. With 3,100 stores in 27 countries, it's a well-known brand, and they're selling primarily footwear, but they also have apparel or minor lines. Most of the stores are owned by Foot Locker themselves. 139 of them are franchise businesses. The vast majority of products is from Nike. Actually, up to 70% of revenue comes from selling Nike. So I can already sense that someone is saying, what about Amazon? At least that's, you know, we've been talking here about GameStop before, Bed Bath Beyond, and it very, very often it comes back to Amazon. So I thought long and hard about Amazon before making this pitch. And at first glance, it definitely seems like just another retailer that's going to be crushed by Amazon, right? And well, Amazon sure is a competitor. With close to half of all market share and e-commerce there in the States, it seems like a company like, say, Nike would go to and then stop working with Foot Locker. But I would argue that is not as dangerous as it may seem. Actually, Nike started working with Amazon because of this reason back in 2017. And after facing all types of problems, they actually stopped working with them in 2019. And the reason for that is actually pretty simple. Amazon's platforms, with all the great things that it can do, also have some issues. Not just copycats and counter and fake reviews, but Amazon is not good at building communities. It's not good at building brand loyalty for the seller, especially not if that seller is a company like Nike. So I'm not supposed to pitch Nike, so please forgive me for talking about it, but it is, after all, 70% of the revenue. So it's really important to understand that company, to understand Foot Locker. And I think you should see Foot Locker to some extent as an extension for many footwear companies. Because whenever you enter a Foot Locker, it's not a great experience. And I hope I don't offend anyone whenever I say that. You know, it's in many ways, it feels like it's a supermarket for shoes. And that's great. And that's also the advantage for Foot Locker. It's a much more approachable showroom and distribution system for another target group that primarily would shop in Nike's own stores. And you can even say that for, you know, the second most important partner that Foot Locker have, that would be Adidas, and then followed by New Balance and Under Armour. You can really say that, and it's very much integrated. So just one anecdotal example, you know, Foot Locker is integrated into the Nike app. You know, so if you have your Nike Plus loyalty program, you will get the benefits. You can even access and pick up your shoes in the closest Foot Locker store. So it's very much an extension of that. All of that being said, Foot Locker clearly has a very narrow moat. I think that's quite obvious. But I also think there are a few things that's a bit different to understand for something like footwear. And it's just controlled in a different way than, say, mass apparel. It's not as fragmented, and the competitive situation is actually more fierce. It's just constructed in a different way. You have a few huge producers, and the price competition is not the same thing. Because the pricing of sneakers is very similar across many different distribution channels. it's tightly controlled by these massive companies like Nike. And Foot Locker is the biggest independent sneaker seller in the US. And so whenever we think of size, we typically think, well, that means they have a lot of pricing power. You know, they can go in like Walmart and go in and negotiate with the supplier. Well, they can't do that with a company like Nike. But what is in that deal, just using that as an example, but it's prevalent in that industry, is that you would not compete on the price. You would have a store like Foot Locker that would target mid and low income families, not so much the fatter margins that Nike can do in their own stores. And a company like Foot Locker get the preferred treatment that they would get their own collections and they would get just after Nike. So if you're going to Dick's or Finish Line that's now being acquired by JD Sports, you won't get the same thing. So that moat, if you like, comes from collection itself and where to go. So whenever I look at some of the valuation, I try to justify this narrow moat that I'm trying to excuse in so many ways by saying that this is a company that's probably not going to grow a lot. It hasn't in the past. It has also not taken the same beating as you see many other retailers have lately. Whenever you look at the bottom line and even the profits, it haven't been shrinking. It's been a bit of a pain here during the pandemic, even though 2020 is still going to be a profitable year. But it still sustains their top line and they're still making a very decent profit. I find a double-digit return for a company like Foot Locker. If I just say flat growth, I come up with 12.5%. I think you definitely can make the argument that it can be hard enough in itself, especially over the coming year. But that is my pitch for the boldest of value investing picks right now. So if I had to throw it back to you, whenever I'm pitching these stocks, and I don't want to put words in your mouth, but it often comes down to Preston saying, dude, we're in a new world. Stop doing that. And Toby, who's like, I really like the valuation and the cash flows on that one. So I'm very curious to see how this discussion is going to go.
Yeah, so that's roughly where I was going to go. I just had a look at the shares out. They've been pretty good at buying back stock. And as a result, the revenue per share has grown pretty well for the last decade, which I was kind of surprised by. It's remarkably consistent. I guess they're engineering some of that growth through buybacks. It's a surprisingly good business on its financials, given what we know about it. It's retail. It's typically in malls. It's got a 70% customer or 70% supplier in Nike. Sometimes I get a little bit concerned with something like this. What if their interests become adverse to Nike's? What happens then? Does Nike need them?
Great question. I would argue that Nike needs them because they can do what they can't. It would be really bad for their brand if they started targeting the same people. But there are a lot of people who are buying Nike products who just do not feel good about going into a Nike store. And I think it's quite evident whenever you walk past a Nike store and then another place in the mall, you have Foot Locker. I wouldn't call Nike stores intimidating at all. That's not what I'm saying. But how do you like to shop? And for most people who are not only brand conscious, but also price conscious, you would go to Foot Locker instead of Nike. So instead of rebranding and having a more approachable Nike products, I would say they would need a company like Foot Locker to do that for them. So to me, it seems like a win-win to do that. But you are right, this is narrow mode. They can't just flip the switch and say, you know what, we're going to do 70% Adidas instead. I mean, that's just not how the business works, unfortunately.
Stig, the thing I'm looking at right now is the management, because when I look at the numbers, to me, the numbers scream that you have very competent management in place and you've had it there for a while, especially for a business that, let's face the facts, everyone in the mall is getting clobbered. And when you look at Foot Locker's top line, they're doing great. I mean, the March event, the whole COVID thing, that quarter was disastrous for them. They were literally down 50%. But this past quarter that they just closed out was right back to where they had been historically for the last 10 years. So that tells me that there is some type of customer. I don't get it. I personally don't get the whole sneaker thing. I know there's a lot of men that go out there and this is their thing is they collect shoes similar to, my wife does. And they're into it, right? I don't understand it, but I think that there is a fairly large market of guys that like to go to these Foot Locker shoe stores and try on these new Air Jordans or whatever. And based on the numbers, it doesn't seem to be getting impaired in any type of way, which to me just does not make sense. I would suspect that because the traffic at the mall, the foot traffic at the mall is down significantly, that businesses like this would be suffering. But the numbers are telling me that that is not true. That is false. When I look at the valuation on it, I mean, come on, it's priced to perform. There's no doubt about it. It's packing in a lot of profit for the price you pay. The margins they're marginal. They're at 6% after tax. So I don't think that the margin is anything that's that exciting, but I do think that the market has penalized the price significantly. And that's where the value is you're getting it because the rest of the market has, I think, had the same opinion that I'm having at a superficial level without doing the deeper dive into the financials. They're just saying, well, the traffic in the mall is down, so why in the world would you ever own this? It's just, I'm sure when people heard you pitch at Foot Locker, they were just like, are you even serious right now? Like, because intuitively, it just doesn't seem like it'd be doing well. But I'm telling you, look at the top line of this company and the top line is rock steady. So I do find it an interesting pick. I don't like it long term. Like, is this something that I think is going to do well 10, 15 years from now? I don't know. I'm not so convinced. But over the next 3 years, do I think the price could come back because it's just so cheap and for the profit that they're kicking off? Sure. I don't own it. I don't think that the momentum on it's that great, but it's a surprising one to me. I think, you know how I would describe this? If somebody's listening to this and they're in like grad school or they're, getting an MBA or a finance degree, I would tell you this is a really interesting pick to look into and to study from the financial statements because you can see how well this company is being managed. You can see, and my first point there about the CEO. The CEO's been there for a long time. He was the COO from 2012 and has just basically climbed up the ladder. He's now the CEO. He's been there for a long time. I think that this guy really has a good understanding of just business. So those are my thoughts.
Well, I think you put it extremely well, Preston, and I definitely have the same concerns as you. And the reason why I do consider it is, because of the same reasons as Toby talked about. The financial just rock solid. We have a quick ratio, even close to 1 here during the pandemic. So they don't even need to sell shoes. They're still cash neutral. And obviously, they will sell footwear. That's not what I'm saying at all. But it's rock solid. They have more than $1 billion in cash. It won't be the first one to go. And so to me, the reason why I found it so interesting was looking from the sideline, everything that was happening with Nike and like to try it out Amazon. It just didn't work. Nike is not going back and trying out Amazon anytime soon. What's going to happen in 10, 15 years, like you mentioned, Preston, I don't know. Will we see some major disruption here? Probably. Can I make my money back before then? I think you can. I think that Toby has said this quite a few times with some of the ugliest picks that I've had here. And I had a lot of really, really ugly picks. Buy a basket. There are a lot of these stocks out there who I think the market cap is around $4 billion. Not major companies. They're generating a ton of cash. We previously talked about GameStop, and thank God only I was stupid enough to invest in that. And we talked about Bed Bath & Beyond. We talked about a lot of different companies that are cash flowing, but just facing a lot of headwinds. Sometimes you see like crazy source in the stock price because of a Elliott management or someone like that would go in and like take an activist position. That might be an approach for you. I think the volatility for a stock like this can be a bit brutal. And also, I think it's important to say whenever you do your intrinsic value assessment that there's not going to be a huge growth potential for something like that. Whenever you read through the strategy, like how they want to grow, they talk about they want to target Asia and how they're opening stores up and now have a distribution center in Singapore. They talk about the new loyalty programs, pushing for women's shoes. I think all of that sounds good. I think in reality, it's like corporate cliche for we're supposed to say that we're growing. I think a lot of that would be really difficult. And for also having been in Asia and know the brand of Foot Locker, and I'm sure they can rebrand it and hopefully they can. A brand like Foot Locker is not going to be attractive almost any part in Asia, if you ask me. So unless they're really, really good in terms of rebranding that. Thanks for watching. Make sure to subscribe and hit that notification bell so you don't miss out on the next podcast episode and new investing resources.
What are your takeaways and thoughts on this discussion? Let us know in the comments section below.